Imagine you're thinking about putting your money into a company, or maybe, you're just curious about how solid a business really is. How do you know if their finances are what they seem? It's a huge question, actually. And right at the heart of it is this profession that's incredibly important, but, well, often a bit misunderstood. Today, we're doing a deep dive into the world of accounting standards and audits. We'll be looking at why they matter so much for financial transparency and, frankly, global trust. Our sources really lay out the fundamentals here, what auditors do, the challenges they face, and this big global push for consistent financial reporting.
That's right. And our mission really in this deep dive is to pull out the most important nuggets of knowledge for you. We want to give you a kind of shortcut to understanding how companies prove their financial health and, what goes wrong sometimes and the ongoing efforts to make sure you're getting a true and fair view of their situation. We'll really explore the why behind these complex systems. Think of it as getting you well informed on a critical piece of our economy.
Okay, great. Let's unpack this then. We'll start by getting a real handle on what an auditor actually does day to day. Then we'll get into some interesting stuff about what happens when that trust breaks down. And finally, look at how the financial world is trying to create, like, a global language of money. Sound good?
Sounds perfect. Let's jump in.
Okay, so you probably know that companies appoint these external accountants, right? Auditors.
Yep, specialist external accountants.
Their main job isn't just checking sums, is it? It's auditing the accounts and approving them if they think they give this true and fair view of how the company's doing financially.
Exactly. That true and fair view is the absolute key phrase here. It's their professional judgment. And it's that judgment that gives people like you listening confidence in those numbers.
But what if they don't think it's true and fair?
Well, that's when things get interesting. If they have reservations, if they believe the accounts don't provide that clear picture, they issue what are called qualifications.
Qualifications, okay.
And that immediately gets investors worried. It's fascinating, actually, how quickly confidence can just evaporate when those qualifications appear.
So it's a big signal.
Huge signal. Doesn't always mean fraud, let's be clear, but it definitely signals something isn't quite right. Maybe unclear, not fully compliant. The market reaction is often pretty swift. Share prices might drop, regulators might start asking questions. It really shakes that perceived reliability.
Wow, okay. That makes sense. But then auditors themselves have a complaint, don't they? This expectation gap.
They do, yes, and it's a really important point.
What exactly do they mean by that?
Well, essentially, auditors argue there's a gap between what the law requires them to do and what the public and sometimes investors expect them to do.
Right.
They'll say, look, we follow the standards, we check for material misstatements based on historical data, but we're not meant to pick up every single problem. They weren't necessarily guaranteeing the company won't fail next year or that they'll uncover every cleverly hidden fraud. Their scope is specific.
So there's this tension, what the job is versus what people think it should be.
Precisely. And that gap, that disconnect, really came into sharp focus after some major corporate scandals. If you think back to the early 2000s, collapses like Enron in the U.S., those weren't just financial news stories. They were a massive blow to public trust.
Enron, right. That was huge.
It was. And what's often forgotten is how specific accounting tricks, seemingly small things sometimes, like using special purpose entities to hide debt, could lead to such enormous deception. It wasn't just investors asking questions anymore. It was regulators, the public, everyone asking, how did this happen? Where were the auditors?
Yeah, how do you regulate against that kind of, clever deception?
Exactly. And how do you prevent auditors from either being complicit or maybe just, missing it? It forced a real reevaluation.
So it wasn't just worry, it was real anger and demand for action.
Absolutely. Our sources make it clear investors started demanding much stricter regulation for auditors. They wanted closer supervision by authorities.
And this is interesting. It wasn't just the public making noise, was it?
No, not at all. The push came strongly from institutional investors, pension funds, people whose actual capital was at risk.
Right. They realized the system needed fixing to protect their investments.
They did. They started pushing hard for legislative changes because they understood that the audit's integrity was fundamental to the whole market's health.
Okay, so the pressure builds. What do the regulators do, the government agencies?
Well, they stepped up their game. Their main goal became ensuring much greater transparency. They demanded that audits provide a really clear picture, an unambiguous picture, of a company's true financial situation.
Not just catching cheats, but preventing the system allowing it.
Exactly. Preventing those vulnerabilities. And this leads to the question, okay, if transparency is the goal, what specific things do they target? It wasn't vague.
No, it seems quite focused, and the sources highlight two key areas, right?
That's right.
The first one is auditor rotation, the idea that companies should have to change their auditors regularly.
Yeah, maybe every 5 or 10 years, something like that.
What's the thinking there? Prevent things getting too comfortable.
Pretty much. Long relationships, well, maybe efficient sometimes, can risk complacency. Or, maybe the auditors become a bit too familiar with management, too accepting of their ways.
A bit too cozy, as the source puts it.
Exactly. Bringing in fresh eyes, a new firm, is meant to enhance that independence and critical distance, keep things sharp.
Makes sense. Okay, and the second area?
The second big one is conflict of interest. Specifically, should auditors be allowed to do other work, like consulting or tax advice, for the same company they audit?
Ah, right. Because if they're advising on a strategy,
How independent can they really be when they audit the results of that strategy? There's an inherent conflict, isn't there?
yeah, you can see that their advice income might subconsciously affect their audit judgment.
Precisely. So regulators push to build firewalls, essentially. Separate the auditing from the consulting to keep the audit opinion pure, just focused on the financial truth.
Okay, so these national regulators are tightening things up. We've got the FRC in the UK, GAAP and FASB in the US. They have their own rules.
Traditionally, yes. Robust systems within their borders.
But money flows globally now, doesn't it? That's the big challenge.
That is absolutely the core problem today. People, institutions, pension funds, they invest all over the world. Your portfolio probably has international exposure.
Mine certainly does.
Right. So financial reports need to mean the same thing, whether you're in London, New York, or Singapore.
Otherwise, it's impossible to compare companies properly.
Exactly. Imagine trying to compare, say, a U.S. tech firm using GAAP with a German one using IFRS, International Financial Reporting Standards. Under GAAP, maybe R&D costs hit the profit straight away. Under IFRS, maybe some get capitalized, spread out over years. Right. It gives you a different profit figure, different picture.
It's like that apples and oranges analogy you mentioned. If apple means something different everywhere.
You can't make informed comparisons. It creates confusion, risk, inefficiency for investors like you.
Which is why there's this huge push for international standards, a universal financial language.
Precisely. It's a massive effort involving major global players.
Like IOSCO, the International Organization of Securities Commissions.
Yes, IOSCO is key. It represents stock markets and regulators globally. And crucially, the U.S. regulator, the SEC, the Securities and Exchange Commission, is deeply involved. Their buy-in is vital.
So the goal is harmony. Making a balance sheet mean the same thing everywhere.
That's the ultimate goal, harmonization. So you can read accounts from anywhere and understand them on a comparable basis.
And the benefits must be pretty significant.
Oh, huge. It makes global investment much easier, much safer. Investors everywhere can understand and, importantly, trust the accounts of companies no matter where they're based.
It reduces costs for companies too, I imagine, not having to prepare different accounts for different places.
Absolutely. Less complexity for multinationals. But fundamentally, it's about building that foundation of trust and clarity across borders. It reduces what we call information asymmetry, where some people know more than others. It improves how capital gets allocated around the world. And ultimately, it just makes it easier for you, the listener, to assess opportunities anywhere, knowing you're looking at comparable, trustworthy data.
Right. That comparability and trust seem absolutely essential. So we've really covered a lot of ground in this deep dive. We started with the auditor's role, that true and fair view, and the whole tricky expectation gap. Then we looked at how those big corporate collapses really ramped up demands for more transparency and stricter rules.
Yeah, things like auditor rotation and avoiding conflicts of interest.
And finally, this crucial ongoing effort to get everyone speaking the same financial language through international standards.
It's all interconnected.
It really is. And all these layers, the scrutiny, the rules, the global standards, they're all ultimately designed to help you get a clearer, more reliable picture of a company's actual financial health.
Building and maintaining that trust that our whole global economy relies on.
Exactly. Which leads to a final thought, perhaps.
Well, it does raise an interesting question for you to mull over, doesn't it? As our world gets even more connected, with financial information zipping across borders instantly, how might this ongoing evolution of accounting standards and auditing practices keep shaping things? Think about global investment trends. how companies are governed, and fundamentally that trust we place in the institutions driving our economy. What comes next? What are the future challenges or innovations we might see in this space?